Hello, everyone, and welcome to BFW 2401. This is week 10, and we are talking about off-balance sheet business and financial derivatives. Now, the way I planned this presentation for this week is I uploaded one PowerPoint file for all the parts, and the recording will be divided into 3 parts. In the first part, we will talk about introduction, which is actually important to give you some background, but the real materials is actually in part 2, which is the off-balance sheet business, and part 3, which is the financial derivatives. Now, if you allow me, this is what actually we have, and this is week 10. So we are going to first thing I want to this is the introduction part, and actually the first thing I want to show you is that the FRS 10, which is this accounting standard, is in place, and it comes in 2014. You are not responsible about this accounting standard, but just to give you an information, there is something called the face value and the credit equivalent. Now, with FRS 9, actually derivatives are reported in the balance sheet with the credit equivalent according to this standard. Now, right now, what we call it when we talk about off-balance sheet business, we are talking about derivatives and off-balance sheet business. As far as the reference is concerned, there is information on derivatives in chapter 16 in our book, but there is some other additions, resources. This is an old book, but it's a good book actually. But actually, we have also online resources, which is free access. You can access EBRA. This link actually will lead you to the financial derivatives and Australia. There is also some data. If you are interested in data, they will show you the data classification according to the type of the derivatives, which is actually in this link. And then if you want to talk about or you see the derivatives in Malaysia, then you have to go to Bursa Malaysia. Bursa Malaysia is actually controlling most of the trading of the derivatives, if not all. Everything about the trading is actually in derivatives is done through the Security Commission. Now, if you are talking about Japan, Indonesia, Korea, all those countries, they have some regulations, and please check it in your own country. We just talked here about Malaysia and Australia, and we are not talking actually about specific country. Just to give you some sense about it, you can access those links, which just show you some background about it. If you actually, it's not examinable, it's just for your information. Now, the learning objective, we want to discuss the relative importance. They are very important to talk about. This business is becoming a very important for banks, derivatives and off-balance sheet. Also, it holds a lot of risk. And we will want to talk about the major types of off-balance sheet. Now, before I continue from here, when we talk about off-balance sheet business, we have the derivatives, which is one part, which we call it from now market-related, because any derivative contract is connected to the exchange rate, to the equities, to the interest rate. And this is what we are trying to hedge. And those actually move as the original assets move. For example, if you have a forward contract or any other contract or options related to hedge interest rate or speculate in interest rate, when the interest rate moves, it moves. Now, when we talk about the other businesses, which is a lot of business in banks, considerable amounts actually, like guarantees, letter of guarantees, letter of credits, standby letter of credits, loan commitments, all of those actually are non-market related. So maybe we take this point from here, which is we have market related and non-market related. Now this, when we talk about, actually we'll talk in part 3 on the derivatives instruments. And we will also see why the banks actually participating in off-balance sheet business and explaining the key purpose of bank derivative transactions. Actually, we are talking about hedging, speculations, and trading. Now, this is my agenda, which actually summary for the learning objective. We want to know what is OPS, and we will talk about the overview of derivatives, and we will have calculation about what we call the forward rate agreement, and then we will conclude. This is an old information, but it is still, even if you take the information until today, you will find the same thing. When you look at the off-balance sheet derivatives, the face value, to the on-balance sheet, so this is the off-balance sheet businesses, derivatives, you will see how much they are, comparing to the on-balance sheet. So they are actually huge, and it's 4.49%, which is 4.9 times. You are talking for about here we have 5.5, 5.6. This is if you look at the years, and if you continue, you'll find this, and it's actually keep increasing. So this is actually the difference between the on-balance sheet and of the balance sheet. This is the face value. When we say face value, for example, if I have a contract of $10 million of oil, for example, commodities, and we speculate or they hedge the price of the 10 million, so the price doesn't go up or down, then in this case, this is what we call it the face value, the 10 million. And you will find this contracts and face value is huge comparing to the on-balance sheet. This is Australian banks. In Malaysia, we have the same, and actually I think, talked about it last time when we talked about the off-balance sheet. I think when we talked about the performance, but still we are talking about 25, 26. I check it unless until now, 2020, 21, you will find also you are the same percentages, which means 25% to 27%, to 20 to 30% of the total, business, which means the on-balance sheet business. This is only 25% of the off-balance sheet business, which means in Malaysia, is the derivative market is not huge as Singapore and the other countries. If you are from Sri Lanka or Indonesia, Korea, some parts in Africa, or you can check this and you will see how big is it. Now, when measuring the importance of PAS, we typically use the face value. This is what I told you of the transaction. For example, if a bank buys a future contracts with face value of 1 million, this would count 1 million in OPS. But actually, this is an overstating the bank's exposure to losses. An alternative way is to look to the credit equivalent, and the credit equivalent, either through the regulators or through the management of the bank, which they will tell you what is the credit equivalent. It's actually 1%, 1 to 1.5%, depends on the contract, whether you are talking about exchange contract, interest rate contracts, or other contracts. This information actually will help us a lot when we move next week to capital adequacy. Because regulators are very concerned about this credit equivalence issue, and they have tables to show us. But for the time being, just know please that there is something called credit equivalent and something called OPS business. So the credit equivalent is actually, it's the percentage that we expect it to move, or the regulator expect to move, and it's not too much. It could be 1%, 1.5% up or down. Now, as you can see here, the face value is this. the credit equivalent, if you talk about non-market related, which I already explained it, not the derivatives like the standby letter of credit, the letter of credit, the the commitments like the loan commitments and the others. In Australia, 537, the equivalent is 138, which is actually 25%. But if we talk about derivatives, look, it's 5 billion. You have only 5 billion. You have only 105 billion. You will find only 92 billion, which is 1.8. Now, this is a very maybe interesting one, because why? This is the OBS transactions, and I told you why we have it, because it generates revenue. And when we talk here, please try to understand that we have OPS and we have in the same time derivatives. This is the market, non-market related, and this is what we call it market related. So here we have actually direct credit substitutes. We have what we call, this is examples like guarantees, standby letter of credit, bill endorsement, written put options. And in the, they have also they carry risk, and the risk is actually credit risk, liquidity risk, and the interest rate risk, which means when you go in this type of transactions, there is a possibility that the counterparty that are with you in this contract will default, and therefore there is a credit risk. And if they default, there is actually that will, and you have to pay to the third party who are actually guaranteed by this contract. Then in this case, that will pressure your liquidity because you have to pay. And if there is a liability or you created an asset because of this credit risk and the interest rate risk moving, because this will become a liability or a loan. Now, in this case, if it happens, then we will be subject to interest rate risk. This is the risk, related to the performance and trade, and also related to the direct credit substitutes. Now, in the performance part, we have what we call documentary credit, performance-related contingencies, and we will talk about it in the second part in details. The commitment, we have sales and repo, we have underwriting facilities, and we have the loan commitments. This is maybe a little bit new to you, but we will talk about it in details. But this is the three classification. Either it is commitment, when we talk about non-market related, either commitment, or either performance related, or either direct credit substitutes. And I will tell you what's the difference between direct credit substitute and performance. It's the same issues, but this has to be paid. End of the day, this may or may not be paid. Now, without further due and explanation here, if we talk about the derivatives, derivatives, usually these contracts we have. We have forward contracts, we have future contracts, swaps, and options. Any contract actually in derivatives is in this classification. However, we use them to hedge so many exposures, and we engineer those type of. We have forward contracts, for example, for credit risk. We have forward contracts, derivatives. We can use them also for interest rate risk. For liquidity, we can use. We can use also option or futures. But in general, even when we have commodities, we can use all those classification of contracts. In our topic today, we are only interested in the interest rate contracts. We are not interested in foreign exchange or gold contracts or equity contracts or commodity contracts. We are dealing only with the interest rate contracts and this week. And therefore, we will use these derivatives to hedge the interest rate risk, and I will show you how we do it. Now, maybe this is one thing you need to know by now when we talk about the credit equivalent and the face value. Remember, we talked about it. We have something called crystallization. So when you issue or when you sign the contract, for example, forward contracts or options or future contracts or swaps, whatever, there is a contingency that it will happen in the future. And if it happens and you have exposure, we say it has been crystallized. So in maturity, when the contract is actually liquidated, and in this case, you are gaining or losing, there is what we call crystallization. And if there is any issue about it, moving this off-balance sheet asset and off-balance sheet liabilities to the balance sheet, we call it crystallization. So it's contingent items, and when crystallization happens, it's actually it becomes on balance sheet. So when we sign it off balance sheet, and then when the commitment happens, we talk about crystallization. And we also talked about the exposure, and we said there is a face value and credit equivalent. Accounting standards are asking us now to use credit equivalent. I think I have talked why we have to have off-balance sheet business. Very profitable. Simply, it's very profitable. It contributes a lot to the shareholders' value. Actually, some of the huge banks now, most of their work is in this derivative market and business, and they make a lot of money, but they take a lot of risk. And because they make a lot of money, they have this risk. In Australia, approximately 40% of Australian bank profits comes from non-interest income and fees. The risk, when we have derivative market, could be operational risk, credit risk, and market risk. So risk, if there is, when we are involved in any type of contracts, if we are hedging, then in this case, risk can be high if there is no offsetting transactions, which means if we are going and say oil contract, 10 million, and we are actually in that contract. If we don't have protection or insurance for the changes in the price, because the contract will be mature in 3 or 6 months from now, then in this case, we usually hedge ourselves by using some type of transactions. And if there is an offsetting of that risk, then in this case, we are hedging and the risk will be down. So banks actually use derivatives also to hedge their business, to hedge their risks for all of those type of operations. But also they use it for speculation and also for trading, which means selling and buying them. I think I am done with this part, and this is just to add, commitments are expected to become on off-balance sheet. Crystallization of commitment, already mentioned it. For example, if you take, this is just an example. Today, this is when we talk about crystallization. Bank balance sheet has nothing recorded today when we make the contract, which means off-balance sheet contract, assuming it's a derivative contract. Now, off-balance sheet is, if it is a loan commitment, it will be a loan commitment, which means we promise somebody to do a loan commitment. This is when we talk about loan commitment, we can talk about derivative contracts or anything else. Now, bank will earn fees when they issue, this commitment, when they issue this, what we call upfront fee. In 6 months' time, when borrower decide to use the commitment, then the bank balance sheet will be an asset or a loan of 1 million, and this is what we call crystallization. Now, this also applies to all other, off-balance sheet assets and liabilities. So this is the end of part 1, and we will talk about part 2 in a while. Thank you very much, and I will just stop sharing here, and I will see you in the second part.